Okay, in this section of the tape, we're going to talk about the 1 and 4 day percent method. This is the system that I find to be the most profitable in the index products in a trending market. I don't think I ever had a better summer than the summer of '87 trading the S&P using this method. It lends itself, like I say, to other index products, including the stock market, the CBOE index options, the MMI at the Board of Trade, the value line, or the New York Composite, as well as, of course, the S&P. Anticipating some of your comments, I realize that the S&P has a high margin requirement these days, so you may want to consider one of the other ones. But what it does is it plays off of the movement in the volume, whether it's advancing or declining, and it makes a determination based on that whether you should buy or sell. And like I said, in a trending market, it's a very profitable system. And I'll get into this in a bit, but the downside of it is that because it uses scale-up selling and scale-down buying, the stops, by definition, almost have to be quite a ways away, and when it hits the stop, you're going to have a bad day. But more often than not, it doesn't, and it uses some sort of some innovative approaches that I like to the market. And by the way, I've never written about this anywhere or revealed this information in a seminar before, so it's totally new information. So let's get started here. As an overview, I've just mentioned this, it works on all the index products, and it will even, by the way, if you can find markets that tend to track the stock market, from time to time the bonds go with the stock market, though not always. You can use it for that. It utilizes the advancing and declining volume on the New York Stock Exchange. These statistics are available every day in the Wall Street Journal or in Investors Daily or most other financial pages of newspapers. So it's relatively easy to get the information you need. It uses the volume, like I say, in the New York Stock Composite. The entry signals can be used on other futures as well if they track the stock market in any meaningful fashion. The approach, as every good approach to the market has to be, is flexible. And by that I mean it doesn't do the same thing every day. It does different things based on whether the market is trending up, trending down, about to change. It utilizes a money management technique, which I also think is important. It doubles on certain trades. It takes more contracts on some trades than others. As I said before, it utilizes scale-up selling and scale-down buying. It has a money management feature that doubles on some signals. And these are part of every good system. Really, you have to pay attention to money management. It doesn't really matter if you have a system that gives you the high and low with 100% accuracy every day. Unless you have your money management under control, you're going to find that you're in trouble. I often tell people that you're more important than the system. There are a lot of good systems out there, but the people using it is what determines whether it's a winner or loser. I can give the same system to 10 different people and have 10 totally different results, even if it's totally mechanical. And the reason is, if you're a certain type of individual, you'll watch a system until it tends to have a winning streak, and then you'll go in, start trading it, and it'll go into a losing streak, as all systems do. Or you'll trade it, have some winners, and then you'll decide you don't want to be a 2-lot trader anymore, you're going to be a 6-lot trader, and then the losing streak will come along, and you'll find that you've committed too much at the wrong time, whereas you should have just stayed with the same amount, and been able to go through the losing streak. On the other hand, if you go into a losing streak, you may say, well, this system is no good at all, but it was just in a period when it was in a downtrend. Most people do the wrong thing. They wait for a winning streak. They buy at the top of the market, not when things are bad and about to get good. So they hurt themselves that way. Now let's get down to the nuts and bolts here. How to calculate the daily percentage. The daily percentage is very easy to calculate. You take the advancing volume and you divide it by the advancing volume plus the declining volume. This will give you a percentage every day. The unchanged volume, which is also reported in the newspaper, you ignore. So it's only advancing volume and declining volume, and the formula is very simple. You take the advancing volume, divide it by the advancing plus the declining volume, and you'll get a percentage between 0 and 100. That percentage is known as the one-day percent. We'll get to that here in a second. We'll start off with an example, how to calculate the daily percentage. Again, this is after the market closes, so if it's Tuesday afternoon, you take the advancing volume, divide it by the advancing plus declining volume. We'll assume in this case that the advancing volume, and I should mention that it's not advancing shares, but the overall volume. The markets also report the number of shares that advanced in a day and the number of shares that went down. So you got to make sure you're using the volume of those shares and not the number of shares themselves. And it tends to be, of course, in the millions. Here's a typical day was 87,772,000 shares up, 49,784,000 shares down. You can eliminate the last three zeros or even the last three digits as we had in the example here, and simply divide 87,772 by the same amount plus the declining volume. In this case, the percent came out to be 63.80%, and it helps to carry the percentage to 0.01 of 1%, and you'll see when we get into the trading decision tables why that extra carried out to 0.01, 1/100th of 1% can be valuable. Again, if you have any questions about the calculations, look in the book and we have them all there. So right here we have a 63.80 percentage. That's a one-day volume. Now you need to know both a one-day average percent and also the 4-day. So you take the one-day average 4 days in a row and you divide by 4 and you create the 4-day average. So you should have 3 columns like we have on the screen. There's day 1, 2, 3, 4. 4, of course, is the latest day, 3 the day before, 2, and so on. So you have 4 days of one-day average percent. The first day, 4 days ago, was 28%. The second day was 49. In this case, the third day was 43. And the fourth day was 63%. You add the 4, you divide by 4, giving you a 4-day average on the fourth day of 46%. So now we have two numbers. We've got a 63% one-day average, and we have a 46% 4-day average. It's important that you know how to calculate these because we're going to use them when we move on to the rules. Here on the example on the screen we have the 4-day average, how it's calculated. The previous 4-day one-day averages divided by 4, and we just went through this calculation. It came out to 45.75%, and we rounded that off to 46%. Now, we've used this 10-day average range in the market on a number of other techniques, and in this method it's also valuable to have. So we take 10 days of high-low data, we subtract the low from the high, creating a day's range. We list that in the column, then we add up 10 days and we come up with a 10-day average. So on day 10 here, the day's range was 215, the average was 345, day 11, 195, and the average of the prior 10 days was 3.30. So this is all pretty straightforward calculations. General rules. Now, you have to remember that there's general rules and there's exceptions to the rules, and we're going to work through every single one, so hopefully you'll have a good grasp on this. But let's start out on the very simplest type of rules. And by the way, you always use the rule which is the last to qualify. So these are the very first. When the 4-day average is 50% or greater, the next day is a buy. You only think about buying, not selling on that day. When the 4-day average is under 50%, the next day is a sell. You only think about selling on that day. So these are the very general rules that we want to start with. Everybody, I'm sure, can understand these, but it gets a little more complicated as we get into the method.